Now, Portia gave us a very nice submission by saying, yes, there will be a decrease in asset stock, but also an increase in asset cash, because the business is going to take the money, the cash. If it's a check, what if the person paid check, right? Then that will be bank. So in accounts, when you see anything related to check, we are referring to the bank. But then my question again is, what if the customer did not pay? Then what is going to happen? If the customer did not pay any money for the books we supply, what is going to happen? Yes, Prof. Josephine.
Sir, please, there will be decrease in assets stock and decrease in assets cash.
So Prof. Josephine is suggesting that there will be a decrease in stock, which is correct and acceptable, but the corresponding decrease in cash. Prof. Josephine, you would have to convince us. So this person takes the books and didn't give us any money, right? Do you still think our money is our cash is going to decrease?
No.
No.
Okay, so I can see some professors are itching to submit. But no, let me get some professors to talk. Let me get some professors to talk. Prof. Kujo, are you there? Prof. Kujo.
Sir.
So if the customer does not pay, what do you think will be the impact?
Zero.
Okay, so Prof. Kujo is suggesting 0. Prof. Me, are you Bonte? I haven't heard your voice today.
Sir, increase in credits.
Increase in credits. Yes, interesting thoughts coming up. Awesome. Prof. Oswell, let me hear you. Prof. Oswell, I think Oswell is thinking about it. Yeah. Eugenia, can you assist? Even though this is your first time join us, Prof. Eugenia.
Yes, sir.
Unfortunately, I cannot hear Eugenia speak. Let me pick on the last person, and then okay, the last two. I see Portia and my colleague Eugenia. For some reason, I'm not hearing you. If you can type in the chat, I'll be very glad. Okay. So, Prof. Portia, let me hear you. Your hand has been up since the creation of Adam and Eve.
Okay, say the effect to be on increase in liabilities. That is the creditors, by the creditors.
Prof. Portia, by the time if we don't take care, you finish the whole class with your technical submissions. Let me pick on Prof. Akoli. Prof. Akoli, you had your hand up. Let me listen.
Oh, sir, it's the same thing.
Okay, so Eugenia says, what I know is what you have typed on the screen. Prof. Abubakar, can you share your thoughts on this one?
Sir, please, I just joined the class.
Oh, okay. So maybe you'd have to, pay a little attention, but I recorded the lesson, so you would have it on the page.
Okay, sir.
That's
okay.
Great. Now, professors, let me save you the stress and say that if the customer does not pay, remember here, it is the business that is selling the goods, right? So the people that will be selling to are the customers, right? So if the customer does not pay or does not settle, the customer becomes a debtor to the business. So I was hearing Prof. Portia saying creditor, so not a creditor, but a debtor, right? The customer becomes a debtor. And as we all appreciate, debtors are assets, current assets, right? So if the customer does not pay, then there will be a decrease in asset stock, all right, because we are selling the goods, so the stock will decrease. But there's also going to be increase in asset debtors. So, professors, I'm taking it again. If you sell goods and the customer does not pay, your stock will decrease, so decrease in asset stock. But then you are having a debtors. A customer is owing you now, so you would have a debtor, meaning an increase in asset debtor. Please, professors, do you understand this?
No.
Okay.
No.
I know you will fight me on this one, unless I give you realistic example. First,
Sorry.
so hold on and let me explain with more examples so you appreciate. If a business sell goods, right, the business can take the money or receive the money. Okay, so we call that one when you sell goods for cash or check. So for cash or check. So if you sell the goods and the person pays you cash or check, then the effect will be that your stock will decrease and your cash will increase because the person is paying you cash. So you, the business, you are getting more cash. Now, the other scenario is where the person didn't pay. So it means you sold on credit. So when you sell on credit, or what we commonly refer to as credit sales. The business sells the goods, the customers do not pay. They will pay later, right? If that happens, again, there will be a decrease in asset stock, right? But this time, the person didn't pay money, so you can't say there will be increase in asset. The person didn't pay. And if the person did not pay, that person becomes a debtor, right? So there's going to be an increase in asset, and that particular asset is a debtor. Now, let me give an example. So, Omega Accounting business, we sell pens. We sold 10 pens to Portia. Portia didn't pay. So what it means is that our pens are going to decrease. So there will be decrease in asset stock, which is pens. But because Portia didn't pay, the business will acknowledge that Portia is owing us, or Portia is our debtor, right? So the business is more or less like getting a debtor. The reason for the suggestion that there will be an increase in asset or debtor. If Portia had paid us cash, then it would have been a decrease in asset stock pens and increase in asset cash because this time we received the money. Professors, do you now appreciate it?
No.
Okay, Portia, let me hear your confusion. And any other person who has a confusion can also bring up. Yeah, let me listen to you, Portia.
Say, please. My confusion is why you are saying there will be increase in assets by the debtors, but that's be increase in liabilities. Now it's a liability, right? Because we've not paid the debtors, we record his name in the liabilities side. That is the credit side.
Okay, so I now get your confusion. First of all, the business is selling to customers, right? So when the bookshop sells the goods to the customer is supposed to pay the business. If the customer does not pay, it is not a liability to the business. That's
Okay.
one. It's not a liability to them, because liabilities are like debts that the business owe. So if the business is now selling the goods to you, the customer, and you, the customer, hasn't paid, right? Then the business see
Yes.
you, the customer, as a debtor, as someone who owes the business. So you become a debtor and not a creditor. A creditor will be where the business is rather buying from the person. This time we are selling, the business is selling to the person. So the person is a customer. And if a customer does not settle or pay the business, he or she becomes a debtor. And debtors are assets to the business. Do you now appreciate it?
Sir, sorry. Now if I remember the rules. Sorry, that's we debit to the
Okay.
giver. And the giver is the person is sorry.
Okay. Any other Prof? I think Augustine Akoli was also expressing a confusion. Augustine, are you okay?
Yes, please.
Okay, that's fine. Any other confusion from my other professors, Emmanuel Kujo, Frances Oklo, Josephine, Ni Ayibonte? Okay, so let me give some concluding statement on the sale of goods. Note that anytime a business sells goods, the first impact will be the decrease in asset goods, but we use stock. We don't say goods, we use stock. The other effect depends on whether the business received cash or check, or the business did not receive any money. That means that the business sold on credit. Okay. So if the business received the cash or the check, then there will be increase in asset cash or bank. If the business did not receive any money, that's the sale was done on credit basis, then the business is going to get increase in asset data. I think I've given enough examples for professors to understand. But if there are confusion, let me clear them before we move on.
Yeah, please, can you come in?
Okay, on which one? Is it the cash or the credits?
Sell everything.
The everything, okay. Let me hear from Augustine Akoli.
I still don't get the creditor and the debtor.
Okay. Let me see if I can do this on the screen for my professors. And I really appreciate these questions and confusions, because that tells me that at least you are following and you want to understand. Okay. So one thing that my professors should note is that we are recording, or we are looking at the effect from the business, okay? From the business. So we put ourselves in the shoe of the business. Now, this business is selling goods, okay, to a customer, okay? So note the difference between customers and suppliers. Customers are those the business sells goods to, and suppliers are those who supply goods to the business. So, for example, if this our class is a business and we sell books, any student we sell the book to is our customer. But where we get the books from will be our suppliers. So, for example, if we go to Malcolm to also buy the books to come and sell to the student, then Malcolm will be our supplier, okay? And the student we sell the books to will be our customers. If you understand that one, we can make progress. So if a business is selling to a customer, I'm saying two things can happen. The customer can pay the business cash or check. Or the customer will not pay at all, which means that the business sold to the customer on credit. And I believe you've all seen this when you go to some shops, no credit. It means that when you are a customer and you get there, you have to pay your money. You can't do any credit things there.
Okay.
So we are now looking at the business selling to a customer. So listen carefully. If the business sells to the customer, the first thing is that the goods or the stock will decrease. And I believe we all understand that one, that when you sell the goods, your stock will decrease. So there is a decrease in asset stock. Now, if the customer pays cash or check, meaning the business received the money from the customer, professors, I'm telling you that will mean our asset cash or bank will increase because we are getting the money. But if the customer doesn't pay the money, then that customer becomes our debtor. Please, do you appreciate that one? He's becoming our
Yes.
debtor. He's becoming our debtor because he didn't pay. So this time we are not going to have any cash or bank because the person didn't pay. So instead, we would capture the person as our debtor, right? And that is suggesting to us that there's an increase in an asset called a debtor. I hope it makes sense now.
Yep.
Yes,
Okay.
sir.
Yes, please.
Yeah, please, the others, are you okay now?
Yes, please.
Okay. Now,
Yes.
maybe I should give another example, okay? Then maybe, or let me give one specific example on this sale. So example, 1st January 2025, okay? So the business sold goods to AC 50 Ghana cedis on credit. So if you see a transaction like this, you see that, okay, the business has sold goods to a customer, AC, but AC did not pay, so it's on credit. So what it means is that the business stock or goods is decreasing. So that one is an established fact. The stock will decrease. But because AC did not pay, AC will become our debtor, right? So a corresponding increase in asset debtor. Let me look at another one. Portia, I'll come back to your question. 2nd January 2025. You see another one. Sold goods to AC 50 Ghana cedis and received the cash of 50 cedis. So look at the second transaction. This time we sold the goods to AC, but we received the cash, we received the money. So that means that our stock will decrease, but we are also getting cash, so our cash will increase. And cash is an asset. So increase in asset cash and then decrease in asset stock. I want to believe my professors now appreciate what I'm talking about.
Yeah.
Yes,
Portia,
sir.
Yes, please.
yeah, Portia, you have a question?
Say, please, I don't still get it. You said that we sold goods to AC. No, not we. Okay, the company sold goods to AC, and AC will become their debtor.
Yeah.
Shouldn't it be creditor?
AC cannot be our creditor because she is not the one supplying the goods to the business. A creditor is a supplier, right? So note the difference. A creditor is a supplier and a debtor is a customer who didn't pay the business. It looks confusing. So a creditor will come in when the business is purchasing goods, not selling goods. And we'll look at the
Okay.
purchase of goods transaction in the next example. But based on the
Okay.
confusion so far, I will not add that one. So today, let's just focus on the investment by the owner, which I believe we all appreciate, and the sale of
Yes.
goods. Okay. So please take your time. Sale of goods, don't get it twisted. I'm saying the business sells goods to customers who may become debtors if they don't pay. Right? If they don't pay, then they become debtors. So there will be an increase in asset data and decrease in asset stock. If they pay the money, either through cash or check, then there will be a decrease in the asset stock because we are selling the stock, but there will be an increase in asset cash or bank. If my professors are okay with what we have done so far, I think it's very, very okay with me as a teacher to pause our discussions here. Question time, professors. Okay. If there are no questions, let me see if I can get some transactions from your manual here for us to discuss the impact. Okay, most of them are bot. Okay, professors, can we look at this transaction here? Please, I want one of you to read it for me if you can see it. One of you should read it. Prof. Ansong, please, can you read what I've highlighted, the transaction I've highlighted? Prof. Ansong, are you there? Yeah.
Yes, yes.
Okay.
Sold goods for 3,550 Ghana cedis in the money bank.
Thank you. So, professors, I think you all acknowledge that this is an example of what we just discussed, sale of goods. So the business sold goods and the money was banked. So my dear professors, if I ask you, what will be the effect on our asset or capital or liability? Yeah, I think Portia is ready to go ahead, but I won't call. Okay, let me call Portia. I have no option. Portia, go ahead.
Okay, so say sold goods for this amount and the money was banked.
Yeah.
There'll be decrease in assets stock by that amount, and there will be increase in assets bank by that amount.
Exactly. Perfectly.
Yes. But say
yes.
Is won't this also affect the cash too?
No, it will not affect the cash because the money went straight away to the bank. So there's no need acknowledging cash because that's not the final destination. Okay. The money's final destination was the bank.
Okay.
Great. Let me see if I can get another one. No, unfortunately, I won't get another one here. So my professors, what I want you to appreciate is that anytime you see sale of goods, the first one you should know is the decrease in the asset stock, right? Or the asset goods, but we don't say goods, we use stock for that. That's the first one. The second one depends. If you received cash or check, then there will be an increase in asset cash or bank. If the customer didn't pay, or if the sale was on credit, then this time it will be an increase in asset data. Don't confuse or miss this thing for me. Thank you very much. So any questions, professors? If there are no questions, let me quickly run through what we've discussed today. So I started by trying to make you appreciate the extended version of the accounting equation, which brings to bear income and expenses, which are also elements that affects, the financial position of a business. But like I indicated to you, the income always increases the capital of the business. So we add it, and the expenses reduce the capital, because we saw expenses to be cost, right? So cost decreases capital, and the income is an earning, what the business is earning. Okay, so that will also boost or add to the capital. Having done that, I went on to look at the effect of transactions on the accounting equation. I think we appreciated some of the transactions that we personally have been having in our homes. But then I sought to take you through 10 basic transactions for us to appreciate. And the first one was investment by the owner. And I did indicate to you that anytime you see the owner giving something to the business, the effect will be that there will be increase in asset and increase in capital. Why increase in asset? Increase in asset because the owner is always going to give a resource or a property to the business, right? So it could be a car, it could be cash, it could be money in the bank, it could be a building or any other asset, right? Then the second transaction will be sale of goods. And I believe now my professors appreciate this sale of goods transaction because we have explored in detail what it means and how it affects our accounting equation. So hopefully next time we'll look at the remaining 7, which includes purchase of goods. So when the business purchases goods, what happens? Purchase of assets. When the business buy a land, a building, a car or a vehicle, what happens? Payment of expenses. When a business pay rent, when a business pay wages and salaries, when a business pay insurance, okay, what happens to its assets, liabilities, and capital? So on that note, I'll ask if my professors have any questions. If there are no questions, I'll be glad to sign off and see you later. So questions, professors? No questions. But like I've always been doing, I'll put some transactions on the page which borders about investment by the owner and sale of goods. And I want to see how my professors will submit answers on that one. So please take very good care of yourselves. I'll see you when I see you. Again, apologies for the network challenges we had along the way. Bye-bye. Please, if you don't say bye-bye, all of you should say bye-bye. Each and every one of you should say bye-bye.
Bye.
Anson, Emmanuel,
Bye.
Kujo.
Bye-bye.
Bye.
Me, Ayi Bonte, let me hear bye-bye.
Bye-bye.
Some of you are abusing the bye-bye.
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 Bye.
Huh?
Hey.
Oh, it's possible. Okay.